Hello, everyone, and welcome to Real Estate Daily. I know I've been missing in action, but this is the beginning of the week on a Monday, and we're going to go over the latest news this entire week next. Yes, I know you've missed me. I know there's a lot out there. You know we start off every single Monday with the Kobesi letter. We're gonna go and jump into the Kobesi letter. What is the big pain points of the week? We're also gonna talk about home prices. Wow, and inventory. Surprise, surprise. I know I'm a broken record, but these numbers continue to show the same path that a lot of media is not telling you. All next on Real Estate Daily. Welcome. My name is Troy, and every day, well, hopefully every day, without having a lot of issues in my personal life, deaths in the family, I try to get out the latest news in real estate, housing, and the mortgage markets. Now, before we jump into it, do me a favor, hit that like button, boom, boom. I'm going to give you the best 5 to 10 minutes on Monday through Friday, a weekday, every single day. I'm going to give you the best news out there. All right, so let's not have any more time. Let's jump right into it. The Kobesi letter, and I know you guys are all looking for it. Again, I keep saying this over and over. If you guys want to jump over to X, this is the best news in the housing market. I know there's a lot of media out there, whether it be influencers on TikTok or Instagram or YouTube or just the media itself like CNBC, Bloomberg, CNN. All they do is they give you fluff and they actually slant the numbers their way. I'm going to give you the straight numbers. Here this week, we have consumer confidence data on Tuesday, which I see nearing all-time lows. Building permits, new home sales data. Well, we saw a slip last week. Quarter two GDP data, which is going to be interesting because obviously on quarter one, we actually revised down. So it was a lot worse than was initially reported. We're going to see if that's revised down again. Pending home sales on Thursday. Fed chairman speaks on Thursday as well. August CPE inflation data, and total of 6 Fed speakers this week. They all have their own agendas. As we told you last week, when they came out with the Fed going flat, not actually raising rates, there were 12 Fed chairs across the United States that said they saw another quarter base interest rate hike this year, and then six that said no, we don't see it. So now at least we have a third saying yes, we're not going to see it. We're hoping that pendulum swings. We already know that they're already bashing this already poor economy, that there's the higher end jobs are falling off the face of the earth, and we're having just the low end menial jobs pop on, and that's making the youth angry at this moment. Why? Because they can't get the American dream. Let's go take step by step. Who wants to find the love of the other love interests in your life? Or actually, you don't have to, but you want to be able to afford a house because that is your family wealth going forward. If you don't own a house and you go through life without a house, for most people, you're not going to have a wealthy life. All right, let's jump in the next article here. And again, it's a Kobesi letter. Give them a follow on X or Twitter. This is very interesting information here. It says prior to 2020 or 2020, just 4% of all outstanding mortgages had an interest rate of below 3%. Think about that. Below 3%, only 4% had it 3 years ago. Now a massive 23% of outstanding mortgages have interest rates below 3%. That has gone up, 50%? Not 50, it's gone up 500%, excuse me. It's gone up over 500%. We are seeing enormous gains right here in this. This is kind of crazy numbers, but this is why nobody wants to sell their home. If you're having a quarter of the market under 3%, well, why would you sell your home and get into a 7% interest rate? Makes no sense. That's why there's no inventory. That's why the housing market's strong. Now it says the share of borrowers have an interest rate between 4 or 5% fell from 40% to 20%. So a lot of people refied their homes, but if you really look at it, 23 and 20%, half the people have interest rates under 5. Wow, that's crazy. It says, meanwhile, just 9% of all borrowers have interest rates of 6% plus where rates currently stand. So guys, 9%, less than 10% of the entire market has interest rates of over 6%. Why would you sell your house? You're staying in it until we get past all the Fed wrecking ball, right? Doesn't make any sense. It says, Were you locked in historically low mortgage rates? And they start showing this whole chart right here of how mortgage rates have gone up or down or where we're at. Here's in the threes, way down here. So we're just seeing quite a lot going on in this, and this just continues to strengthen the argument that there is no one wanting to sell their home because there's nowhere to go without having an enormous increase in your interest rate. All right, so last Friday, what did we see here? This is from Diana Olick. Oh my God, home prices strong despite high rates due to low for sale supply. I keep saying that? But then again, I keep seeing people over and over keep saying the same thing. Housing crash, housing crash, housing crash. There is no housing crash, guys. Again, every single week, I go over the foreclosure numbers here in Southern California, and they have steadily peaked at about 150, 160, and now they've come down this week. As of last week, active foreclosures in all of Southern California was 124, according to the CRMLS. That is our local MLS that covers every county except for San Diego County. It has some San Diego County and some high desert, but you're looking at the majority of Riverside, San Bernardino, Orange, and LA counties, 129. When you kind of look that over, that's just nothing. It's virtually considered, a quarter of 1%. That's for sale. That's actually a foreclosure. And all those banks are just as greedy as their sellers that are out there right now in the market. They're not handing anything away for free because this is a money-making activity on foreclosures. All right, let's jump into the next one. Now, do me a favor. If you like what you're seeing here, hit that subscribe button. I really would appreciate it. It really helps out the algorithm. I'm going to give you the best information on a daily basis. This is from the Housing Wire. It says existing home sales moved lower in August, according to National Association of Realtors. This is crazy numbers. This just exclamates the point. Existing home prices fell. Existing home sales fell, let's say, less than 1% from July to August. That means in the hottest months, we're still seeing an incline in the amount of homes sold. And what's really crazy, it's 15% less than a year ago. We're down 15% from a year ago. There's no sales out there. Why? Because there's no inventory out there. Think about that. These numbers are historic lows now. We're not coming to 5-year lows, 10 years, 15 years old. We're talking about historic lows. And this is really, driving that market. What asset do you have out there is not inflationary? Well, we know that fuel is inflationary right now significantly. We know, prices for food, prices for shelter, prices for insurance, prices for everything, and prices for homes. That's the only thing that if you're a homeowner, you're celebrating this moment. Because you can't celebrate fuel and food, you can only celebrate homes. And that's what at least your strength is that when inflation goes up 10, 15%, you saw your houses go up 10, 15%, right? In reality. Now, year over year, they haven't gone up that much, but the 2 prior years, they went up anywhere from 10 to 20% per year, where inflation wasn't even close to that. So that their best financial investment for most all Americans is their house. They can live in it. There's not a stock or bonds that you can't, what are you going to put? The paper over your head when it's raining on you? You're going to sleep underneath it and pat it on you? No, you can utilize this investment more than anything else, and it usually is your best investment. All right, let's jump into the rates. Now, before we do that, do me a favor. If you have any comments, please leave them below. I'm more than happy to respond to them. Otherwise, guys, this is going to be the rates for today, or as of last Friday. We did see FHA go down about 5 basis points, but we're still over 7%. We need that under 7%. What's more concerning, of course, is conforming is at 7.3%. And we're going to see this week, there's not a whole lot of financial data. And there's several things that are happening that I didn't go over in the Cabesi letter. Number one, we're going to see if we're going to have a stoppage in work by the end of this month in the U.S. government. Now, am I torn between it? I'm absolutely torn. The government spending is now at a record as it's doubling, tripling record paces. There is, for my eyes and my eyeballs are seeing, is that there is no no consciousness of trying to repay this. I think they're here to tear the system down and spend as much money as possible. That's my personal opinion on this, because there's no way you could do that much reckless spending. We're spending about $30 billion a day in government. Think about that, $30 billion a day. We're doing $1 trillion a month. And the only way we're doing it is Janet Yellen popping out those treasury bonds, those 1 month, 3 months, 6 months, and 1 year treasury bonds with such high interest rates that the U.S. Public is buying, because that's the only way that they can keep up with inflation. And it's the most, well, let's just say this much: it is the most secure way of putting money back in the market and then receiving money back. If I look at stocks, they're a risk, they're a gamble. We're looking at, cryptocurrencies, they're a gamble, but the bond market is not a gamble. And if you can get 5.5% on a 3 month, 6 month, or even a year, well, I'd rather lock those gains in than to sit there and gamble on Nvidia or, Bank of America or, Tesla, Google, Alphabet, whatever. So those can go up or down. They can shift upon how much the public is spending on their products and not spending on their products. But if I can get 5.5%, you should be already in the bond market and getting 5.5%. That is insane numbers. And we're only going to see that go up because the Treasury needs to produce more. The Fed and the Treasury need to produce more money because they need to feed the pig that's called the U.S. government. Well, guys, thank you very much for joining me today. I really appreciate it. I know there's a lot of news you can go out there and look at. I'm going to give you the best articles, and I'm going to give you the best insights every single day on what's happening in the mortgage and housing market. You guys take care, and I will see you tomorrow.